Good morning. You're watching The Market right here on 18 Hour with me, Aisha Faridi, Avan Dabash, Anisha Jain in the studios. And we've managed to reclaim that 17,800 print after those March 29th lows of sub 17K mark. It's been almost a 5% move that the index alone has seen. We've managed to gain for 8 consecutive days on the trot, and now you're seeing a breakout in, or rather participation from sectors which have been really sleeping all this while. Pharmaceuticals, for instance, they've been managing to power the gains, what with the move coming in on the Divis yesterday, or for that matter, a DRL, etc. as well. The Nifty has now managed to cross the 4-day resistance, in fact 4 key resistances, and over the last 8 trading sessions, FIIs continue to remain buyers. That was the case yesterday as well. So yes, we've managed to cross that peak, or rather hurdle of 17,500, 600, 17,700, and yesterday we managed a comfortable close above that 17,800 mark as well. It's good to see that, it's not the index alone, but you're also seeing good participation come in from the broader end of the market as well. So you've got a positive advance decline ratio at your hand, as was the case yesterday as well. And within the Nifty Bank as well, you're seeing very, very active and positive participation. It's a 10:2 ratio that the Nifty Bank alone advance decline looks like. That's 10 gaining stocks for only 2 declining. So yes, overall good broad participation, and I guess today it's going to be about the FOMC minutes and the CPI data as well, Anisha.
Oh, well, yes, the macro data is a bit tepid, and my guess is today the cues are more skewed towards the downside, because even if you look at the crude prices, they have escalated suddenly to the $87 to the barrel mark. Yes, the US inflation data came in softer than what the street was expecting, but that has fueled the recession fears in the US, and that's the reason the US market stumbled a tad bit. And this morning, the Asian markets too have opened a bit mixed. Talking about inflation itself, yes, the CPI number on a month-on-month basis came in at 0.1% versus the street expectation of 0.2%, but the core CPI continues to be quite sticky. There was that number of around 0.4% thereabouts as far as the core CPI is concerned. Yes, the inflation is slowing down, but it's the food and energy which continues to be a bit heavier. And the FOMC minutes are talking about a recession in the second half of the year, so that's really pertinent to watch. The rate expectations have also moved a tad bit. Now the street is expecting a pause. At least the probability of that has increased. But let's see how it pans out right now. The fear of the market is recession, and that recession fear is actually translating into earnings back home as well. And that was quite visible in the earnings coming in from TCS this time around, when there was lack of visibility, there was disappointment as far as the performance is concerned. And my guess is that will hurt the street more, because overnight we did see the ADR also reacting negatively to the numbers.
Absolutely. Finally, it did come out with its quarterly numbers, kickstarting the earnings season is what I mean. But yes, it was a bit glum, if you will. The fact that, yes, there was that 15% jump in the profit. You did see a year-on-year rise in their revenues as well this time around, but it fell short of what the street was actually penciling in. So the margins were a little bit flat on a sequential basis versus the expectation of a 50 basis points improvement. You did, though, see the company report resilient demand. It was a strong order book. The deal wins as well surprised positively, as you said, at about $10 billion. The book-to-bill improved to about 1.4 times. And the management commentary this time around was a little bit on the cautious side, particularly, Anisha, on US BFSI, although they have maintained their guidance when it comes to the quarterly deal win.
Yeah, it was actually the first time that I heard a lot of caution in the voice, and the problem was that there was lack of visibility. They're not calling the worst yet. They're not able to call out whether the first half of the year is going to be worse and second is going to at least pick up. So there's complete lack of visibility as to what the timeline of recovery is going to be like, where the US is going, which is expected to worsen, because this time around the disappointment actually stemmed from the US business, because Europe has actually recovered better than what they were expecting, but there was a sudden sentiment shift, as they acknowledged, from February onwards in the US, and that has led to complete delay in decision making. So the clients are not cutting the budgets as yet, as per NGS, but what they're doing is they're completely on a hold mode as of now. They're delaying the decision making, and they're waiting and watching as it pans out. But Rajesh did point out that US is a very, very nimble economy. It goes into a risk also very quickly, and they come out of risk also very quickly. So the decision making can shift. But for now, the street hasn't liked the numbers at all. There's a 2-3 percentage cut coming in at the EPS level. Brokerages are also not liking the lack of visibility. But we'll chat with the management at 8:25 a.m. today. And then, of course, Kriti and Rajesh will be with us at 8:45 a.m. And we'll try and dissect how the growth going forward will be like as far as TCS is concerned, and how long is this weakness likely to come, because the constant currency growth at 0.6% is at least a 10-12 quarter low, and I haven't seen that number. It was 4% a couple of quarters ago. It's slowed all the way down to 0.6%.
Yeah, but the point also is, Anisha, whether the street has already priced that in or not. And besides a knee-jerk reaction today, are you actually going to see buying come in just yet at today's low or not? And more importantly, if TCS's commentary is this, what do you expect from Infi?
Infi is definitely going to be weak. That's what the street is penciling in, and there is going to be a lot of disappointment on the guidance front as well, given that TCS sounded so tentative. And just about the valuations, yes, they have come off substantially, because at peak they were what, at 34 times? It's down to 24 times. But even when you compare to the long-term averages, it's still just around that mark, or maybe a little higher than that. So valuation-wise as well, if you kind of factor into the account the next 3 years or 2 years are going to be slow, then the valuations are fair. It's not that they're available at very inexpensive valuation, or it's a sale going on and there is a very cheap valuation. That's not the case. So it's evenly poised out of now. My problem is there's no fresh reason to buy into these counters. So valuation is not comfortable enough to get the risk reward too favorable, and there's lack of visibility, and that lack of visibility is going to be the commentary from Infosys today as well, whereas it is penciling in a constant currency growth of 0.6%, but there is a room of disappointment there after TCS's earnings. The margins are expected to remain flat for Infosys because there's the increased travel costs which will impact the earnings, but the management commentary will be important to track what they're saying in terms of the FY24 guidance. If it's lower than 5 to 7%, it will be a problem for the street. 21 to 22% is what street is expecting with respect to margins, but as I pointed out, BFSI will be important, and deal win momentum is something to track as well.
Oh yeah, absolutely. All eyes on Infi now after TCS's commentary. And of course, we can't wait to hear from the TCS top brass as well at 8:25 minutes away from now. But let's try and dissect what the US CPI data and what the Fed minutes are indicating, and what it really entails for the future course of the policy moves and the dot plot. We have Ed Yardini joining in on the show right now. Ed, hi, great to have you on ET Now today. Ed, just wondering, considering the CPI number has slowed more than expected, and the fact that it's the smallest 12-month increase that we've seen since May 2021, do you think that makes the case stronger for a pause in the next policy?
I think it makes a very good case for a pause, but what's especially important is the banking crisis. Even the minutes showed that there was a concern among the staff. The economists that work for the FOMC changed their forecast, and they're actually talking about a mild recession in the second half of the year. So I think the Fed has managed to get the Fed funds rate to a restrictive level and doesn't have to go any further.
This imply now, this time around, with the core CPI jumping about 0.4% Ed on a month-on-month basis, is there now going to be a lot more pressure on the US Fed?
Well, I think the pressure really comes from the data. The Fed always says they're data dependent. And what's pretty clear is that the economy is doing relatively well, but slowing. But what's even clearer is that the rise in interest rates has put a tremendous pressure on banks, because we're experiencing what's called disintermediation. In other words, money is coming out of the bank deposits and is going into the money market funds where interest rates are higher. So the worst thing you could possibly do in a banking crisis is continue to raise interest rates, making disintermediation even more of a problem for the banks. So I think they've got to cease and desist and leave the Fed funds rate right here around 5%. And I have no problems with them leaving it here, but I think it would be a mistake to keep raising rates.
Ed, I'm also looking at, the March Fed minutes, wherein, while on one hand they're saying that all officials did back a 25 bips hike, but I think it's more the future projection that they're talking about, the fact that they actually see a mild recession starting later in 2023. You think it's inevitable because, the talk around recession has lasted for a while now?
Yeah, well, this if we have a recession, it'll certainly be the most widely anticipated recession of all times. It'll go down in the history books, because usually recessions aren't that widely anticipated. And so it's possible we'll talk ourselves into a recession. Or if we're all going to say we're going to be in a recession, we're all maybe going to change our behavior that does that. On the other hand, it probably means that people are being more cautious, being more careful, and maybe that we won't have much of a recession. I don't even think we're going to have a mild one. I think we've been in a recession since the beginning of last year. It's just been a rolling recession, hitting different industries at different times without adding up to an economy-wide downturn.
What is it that you're penciling in terms of the trajectory now down the line from the US Fed going? And do you believe that we are likely to see a cool off in the inflation numbers?
Well, I think that that inflation will continue to moderate. What we're, I think, discovering is that inflation in the goods sector was, in fact, transitory. It lasted basically a year. It peaked at the middle of last year, and it's down quite sharply so far this year. I think it'll continue to remain low. And then, of course, later this year, we're likely to see some improvement in the services area, particularly in the rents area. So I think that inflation is going to cool off without having a recession.
Okay. Good to have you on the show, Ed. Thank you so much for taking the time out and speaking with us today. Well, not just the US CPI, but India's inflation also has eased to 5.6% for the month of March this year. This is, remember, the lowest in a year's time. Even segment-wise, food inflation eased to 4.7%. On the other hand, industrial production for the month of February rose to 5.6% as opposed to 1.2% in Feb the last year. In fact, we have consulting editor Matli Pusnarmath as well joining in to help us break down these numbers.
Well, after a long time, we finally got some good news on the price front. Retail inflation for the month of March 2023 eased to a 15-month low of 5.66, led mainly by a sharp decline in food inflation. This is particularly welcome news because in the month of both January as well as February, we had inflation numbers coming at well over 6%. But before we start celebrating, we must remember that this fall has been driven mainly by the high base effect. That is, when we compare the inflation numbers of March 2022, inflation in March 22 was very high. Overall inflation was at 6.95 and food inflation was at 7.68%. So because of that, in price inflation that we see in March 2023 seems low. So it's really more or less what we can call a statistical mirage. Prices are still going up, but thanks to the base effect, it seems to be a little less. So finally, we've got inflation back within that 6% band. Remember, RBI said that in the fiscal 2024, we're going to see inflation fall to 5.2%. Of course, a lot depends on a whole lot of imponderables, particularly as we've seen in the case of fuel. One really doesn't know after the OPEC cut. We really not know whether oil prices will continue to fall. We've already seen them move up. And given the importance of imported oil in the Indian consumption basket and the Indian economy at large, one really cannot be sure that this is part of a trend. But as of now, the Reserve Bank and government will pat themselves on the back, saying that retail inflation has fallen to 5.66%, conveniently perhaps overlooking the high base effect, the contribution to the high base effect. Remember, we're going into the summer months, and summer months typically we do see the prices of vegetables going up. Cereal inflation might be contained because government has large stock, but as far as vegetable inflation is concerned, we really cannot say. Also remember that even though the Met has predicted normal monsoon, the private forecaster has predicted below normal monsoon. So a whole lot of imponderables, but as of now, we have something to feel a little happy about. Inflation has come in below the RBI's upper tolerance band of 6% for the month of March.
With our charters then, we've got Nooresh Merani as well as Kunal Bothra then on top of the show. Let's connect with them and find out their views on the index. 17,800, we did manage to cross that level. Is that an indication, Kunal, of pretty much what's to come in yesterday's move, given the kind of undertone that we're seeing for the global markets? And what is it that you're working with?
Good morning, Avan. There's a lot of calm in the markets. Like in the last 6-7 days, we've seen steady returns for the indices. Nifty scaling up from 16,800 to 17,800 mark. The Bank Nifty also doing exceptionally well in that time frame. And with this calmness in the last couple of days, what we've also seen is the broader market participation, which has improved quite significantly. So the mid caps, small caps, more than the mid caps and the small cap index, it's the market breadth overall, which has done pretty well for itself. Many sectors participating, even with the likes of pharma, for example, doing pretty well for itself over the last couple of days. Auto stocks, which have been beaten down over the last 3 or 4 months, those sectors have also seen a good recovery. So I think it's the texture of the markets which have improved significantly in the last 6-7 days. I think that tells that this trend is here to sustain. Yes, we may hit a bit of a pause button for the indices. So 17,800 mark, say plus or minus 200 point band is where we may expect the next few trading sessions to be. But then that should be taken with a positive bias. So in case if there is any kind of a mild dip or a correction on the indices, should look out for buying the dips.
Instead of the index, Nooresh, hi morning. Let's talk about IT because given how muted TCS's performance was, the ADR was already down 2% yesterday or rather overnight. Wanted you to tell us about what your reading is on the Nifty IT index in particular.
So if we look at the Nifty IT index, we are seeing a discrepancy in terms of the way stocks are. The index is at a different stage. Different stocks in the sector are at different stage. So you have a stock like Wipro, which is near to 52-week lows. You have a stock like HCL Tech, which has recovered good from the recent lows. Tech Mahindra has created a higher base. Then you have Infosys, which is closer to the previous lows. But then you have small caps like KPIT Tech and other names like a Sonata Software, etc., Persistent, which ended up making new 52-week highs. So this tells you that every stock will have a different move. So every result will have a different move. Unlike the previous times, which was going on from 2020 to 2022, wherein, say, a good result from Infi would imply a positive uptick for TCS, etc. So I think every stock will make a different move. But overall, the downside seems limited, but the rally potential is also limited. So we expect a range-bound move for the whole index in a range of, say, plus minus 6-8% from the current levels for quite some time to come. And say in the long run, if you look at the IT index, it has always been an index which has performed in line with the index up till from 2010 to 2021. It was only in 2021 where it got a big re-rating and outperformed in a big way. Otherwise, over really long periods of time, it's been an index which performs in line with the Nifty. So I think we are getting into that same zone, in line or underperform with the Nifty.
Okay, let's talk stocks as well then. Kunal, what's on your list?
So I'm shifting off from Bajaj Auto and suggesting two buy calls. Divi Slab is the first one, which looks attractive on the charts after yesterday's up move of 8 to 9% plus. I think the stock should be ready for another leg of strong uptrend for itself. So that's a buy. Targets to be kept at 3,300, stop loss at 31.44. And the second would be Gail and Tata Motors. Again, an interesting chart, 2 days of strong up move and then 2 days of consolidation. So stock trading at 460 odd mark looks attractive for a target of 500, stop loss at 445.
Right, okay. Nooresh, what's on your stock radar?
So looking at two buy calls again. So first is a buy on Gail India. Now Gail India has slowly and steadily moved up from the 90 zones after making a strong base. And now if you look at a dividend adjusted chart, it shows a very different picture from the normal chart. So a dividend adjusted chart gives you an all-time high at 110 to 112 zone. So it is just 2% away from an all-time high. In the last, say, 3 weeks of consolidation, the recent high was around 112, which adjusted for the 4 rupees dividend recently. You are above those levels. So a short-term flag breakout is done. Longer-term cup and handle formation in the making should catch more momentum above 110 levels. So at current levels, I would expect a quick target of 120 plus, a stop loss to be kept at 104. Second is a buy on Tata Motors, which has created a strong base at 380 to 400. 6 to 8 attempts over the last 1.5 years. Also 12 to 18 months of consolidation after that big move. And now making 3 to 6 month highs above that 450 mark. We saw a big gap up move with volumes. And holding on to that, we faded for a couple of sessions and now setting up for a fresh move. I expect it to consolidate between 455 to 465 for a couple of days, maybe more. Or it could quickly make a move towards 500. But at current levels, it's an accumulate. I would expect a quick target of 500 and the medium term target would be 550 to 600. A stop loss to be placed at 445.
Let's move right on then. Those are your top trading recommendations then to more news and updates. And the RBI has approved the reappointment of Sanjay Agarwal as the Managing Director and CEO of AU Small Finance Bank. So how is this going to impact the stock? Let's take it across then to my colleague Vamakshi, who joins in with the details. Vamakshi.
Well, Sanjay Agarwal, the MD and CEO of AU Small Finance Bank, has received extension approval by RBI for 3 years, and this approval is in line with the 3-year extension that was sought by the bank. Now, remember, shareholders had already approved the reappointment till April 18th, 2026. Now, it is also important to understand what this actually means for the bank. The 3-year extension is the biggest positive that has come in for the counter, as the street was concerned about the same, given that the key man risk in the case of AU Small Finance Bank was very high. Morgan Stanley says that the stock could stop derating now, and in fact they're expecting some strong re-rating to come in over the next few years. It is also important to understand how the company has fared under his leadership. Now, since his appointment in April 2020, NIMs have improved from 4.8% to 6.2%. The CASA ratio has also significantly improved from 14% to nearly 38%. Loans and deposits have nearly doubled to 55,600 crores and 58,300 crores respectively. However, GNPA and NNPA has remained benign at 1.8% and 0.5%. ROA has improved marginally from 1.9% to 2%, but it is the ROE that has in fact seen a decline from 17.9% to 15.2%. But not just AU Small Finance Bank, there are several other banks that could be in focus on the back of their top PRAS terms ending in 2023. First up, we have City Union Bank. The term will be ending in April 2023. Equitas, SFB, Karur Vyasa Bank, HDFC Bank, ICICI Bank and Kotak Mahindra Bank are some of the banks where the top PRAS term ending will be in 2023.
Okay, Vamakshi, so we'll watch out for AU Small Finance Bank, but all the oil marketing companies will also be in focus because there seems to be a bit of double whammy. Of course, the oil prices have gone up, the crude that is to $87 per barrel. That means that the GRMs have come off sharply as well, and that is expected to hit the margins of the marketing companies. Let's go across to my colleague Somit to understand it better. Hi, Somit.
Well, if you see, it's a double whammy for the oil refining and oil marketing companies. Firstly, because the Singapore gross refining margins have declined, and secondly, the Brent crude prices have also surged. Coming on to the Singapore gross refining margin, they have declined to around $3.7 from $5.2 that we had seen yesterday, and from the 2023 peak of around $14.3 per barrel, the Singapore gross refining margins are down nearly 75%. Now, two reasons why this has declined. Firstly, is the spike in crude oil prices, and second is the reason is the fact that the higher refined product inventory has led to this drop in the refining margin. And when it comes to Brent crude, they have surged to around $87 per barrel level, and this surge is owing to the lower than expected inflation in the US and on surprise OPEC voluntary cut in output that we had seen last week. Now, higher crude prices means that the marketing margins of the retail fuel or petrol and diesel comes down for the oil marketing companies. Now, on the refining side, if you see, generally a $1 per barrel drop in the gross refining margin impacts MRPL's revenue by around 700 crore rupees. For IOCL, BPCL and HPCL, their earnings come down by around 14 to 16% by every $1 per barrel drop in GRM, and for Reliance Industries on a consolidated basis, their earnings get impacted by around 4 to 5%. And when it comes to the marketing business, now the current crude prices are around $87 per barrel, and a few weeks back the crude prices were trading around the $75 per barrel mark. So a $12 increase in crude oil prices have reduced the diesel marketing margin by around 2 odd rupees, and for petrol the marketing margins have come down by around 5 rupees per litre for the oil marketing companies.
Meantime, Morgan Stanley has upped the target for Sun Pharma now to 1170 rupees per share, maintaining an overweight stance. Let me take it across to Pankaj and find out what makes them so bullish, Pankaj.
They were already bullish as far as Sun Pharma is concerned, and then they have gone ahead and increased their target price now as well. They have cut down their earnings estimate, but they're saying that valuations for pharma sector are likely to increase from here on. Their target price is 1170, and now it's been upped, which means the sort of upside that they were expecting, now they're expecting slightly more upside. What happens to Halol from here on will be an important thing that they are citing. Overall, a little bit of EPS downgrade is what they have done, but very, very marginal. But saying that other things, new approvals, currency depreciation, all of them, can actually compensate for that. A few key product catalysts are the main thing to watch out for in the near term. That's what essentially they are telling their clients, that as more and more products tend to come in, that is something which will actually impact the numbers. Pharma was one of the buzzing sectors yesterday. However, Sun Pharma did not fall with the pharma sector, and that's why it only rose very, very marginally going into probably with this entire pharma rally that we saw yesterday.
about the pharma rally and the Sun Pharma upgrade coming in from Morgan Stanley, but it's all going to be about IT today, so let's discuss that a bit more. Kunal, wanted your take regarding TCS and Infosys. Is there any trade ahead of the earnings for Infosys, and TCS likely to react negatively to the earnings, I believe?
Yeah, guess so, but I would still believe, Nisha, that the stock would be more range bound as such. So 3,200 has been a pivot for TCS over the last 1.5 odd month. The stock had swung to 3,100, and on the upside, I think 3,330 was the high the stock has made. So I think it wouldn't come as a surprise that the stock may come back and drift mildly below the 3,200 mark, assumingly post results if there is a weak kind of reaction. But again, it would probably get the stock back into that pivot range of this 200 odd point for itself. Same would be the case with Infosys, but I think the bias for Infosys would be a slight bit more bearish on the charts, because the stock has been weak going into the result season, as well as over the last 2-3 months. It's been relatively weak as compared to the likes of maybe TCS, or even if I try and compare with the likes of Tech Mahindra. So I think the approach for TCS would be completely different than the approach for Infosys.
Okay, so the approach is going to be different, but what the street did not like with TCS's performance was the lack of clarity regarding FY24, whether the near-term headwinds are likely to persist, and would that mean that the first half of the year is going to be even slower than the 0.6% constant currency growth that we have seen in Q4. But I'm guessing Nikunj will help us get more details on that. He's in conversation with Milind Lakkar as well as Samir Seksaria of TCS.
Right, Insha, thanks a lot for that. Time for a quarterly chat with the top management of TCS. And this time around, I would say Samir Milind first. Good to connect with you. Maza nahi aaya numbers. Not the quarter which everybody was anticipating and expecting. From a statement of all is well, things are not looking all that well. Will you agree with me?
All is well. It can be always be better.
It's a quarter where you'll have to perhaps convince the market and shareholders that is there a slowdown and is there an uncertainty which has hit the business in the near term. How would you clear the air? Because that's what everybody wants to know. I can get into a quarterly number here, a height count number here and there, but the bigger concern is that is the big picture slowing down dramatically?
So if you look at it, it's a dichotomy. In the near term, there is a lot of caution. There is risk averseness. And risk averseness is coming, and if we split that across markets, UK, we called out that early on, about 2-3 quarters back, we started seeing that customers are getting more proactive and starting to make decisions in the times of uncertainty as well. And then we saw that translating into deal wins last time. And if you see this quarter's revenue, it has come in significantly better than most of the other geographies, very well. In Europe, we called out last time that we are seeing change in stance and customers are being proactive. We see a significant number of 50 million plus deals coming in from Europe this quarter, right? And hopefully that trend continues. What has happened is in North America, things changed relatively from what we expected would be just a temporary one into what we saw into February and March. Caused a lot of macro uncertainty and client being a bit risk averse, reflecting into what happened. And we can link it to the financial volatility in the banking system causing it. So near term, there seems to be a bit of concerns, but what gives us confidence is on the long-term picture, the deal wins which we have had, and that's the dichotomy, that while in the near term, clients in some cases have either hit the pause button in terms of stopping some discretionary projects, pausing them, or not starting projects which are not critical. But they are still investing into deals which will help them do longer term transformation ones, deals which will help them optimize cost, or some things which will help them focus on getting faster ROIs. And that is reflecting on our order book, a 10 billion order book, 5 billion coming in from US. BFSI, where there is a lot of concern, we are getting a 3 billion order book. Our typical one is between 2 to 2.5 billion. There also it's 3 billion. So I think in the medium to long term, things will be well.
Define the near term for us, and will things get slightly more volatile before they get better? I'm talking about near term, next 2 quarters, FY24 specifically.
That's where the uncertainty plays out, Nikunj, and we'll have to play it out as it comes. Our focus will be staying close to the customer, staying relevant, and as it plays out, and we are going by what we have seen in the near term in UK. So our expectation is based on that what played out in UK for us, and we see parts of it playing out in Europe. Gets played out in Europe completely, and then in US also. Also, what we have seen is customers have a tendency of there's an immediate impact which comes in, and then they have to rely on technology in some form to get their agendas also. So if they want to take cost takeout in a recessionary scenario, that becomes the biggest imperative one. They'll usually fall back on technology, and that's where we are optimistic that that should play out going forward as well.
So I'll prompt you for a number. When we spoke to NGS last time, he said, look, there is a probability, not a possibility. There is a probability and a possibility of a double-digit growth. Looks like if you're starting the quarter on this kind of a sticky wicket, a double-digit growth for FY24 will be an aspirational number. It will not be a realistic number.
Our aspiration will remain double-digit. Given uncertainty, too difficult to call out how it plays out.
Can I read it between lines?
Don't read between lines. I'm saying it as it is, Nikunj, that our aspiration and focus will be to get to double digit. Let's see how it plays out.
Okay. Ek saal pehle we were talking attrition. Now we are talking about reduction in headcount. A lot has changed. And this kind of volatility is rare in a business like IT, which has a structural tailwind, which is at the curve of a multi-year cloud implementation. 2021, we were talking about moonlighting. Now everyone is saying that forget moon, the sun is also not shining.
So what do you want me to say?
I want to understand how are you managing this entire flux which has come.
See, I think we have been doing it for now 5 decades, so we actually know how to operate this very, very well, looking into all the dimensions of how we need to operate effectively and efficiently, where we need to invest, when we need to invest, how do we basically bring in 30,000 people in the first half of the last year so that we basically go through this kind of things, in a way which is actually, least impact our financials in a negative manner. So, some of these things actually come together so beautifully. Contractor costs, subcontractor costs coming down, visa things are getting up, so we are able to send people and basically also keep them happy in the process. Obviously, business priority is there, but people also are equally important, and they get the opportunity to basically have global assignments. And then, internal optimization. How does that happen? How do we basically deal more with the same, and how do we bring in more automation? All of these things, technology also plays a significant role in driving these optimization decisions along the way. And the demand or the hiring demand does not only depend on business demand, it depends on all the internal factors which I just talked about. And that's how we are able to manage last 2 quarters with 821 and minus 2,500 last 2 quarters, and still able to show the double-digit growth for the year.
Will you be honoring all your commitments in terms of the offers which you've rolled out? Because some of your peers are in double mind. They're delaying offers, they're delaying hiring, even at campus. Would you be honoring everything?
We have honored all the offers, and our people will have already, most of them are already onboarded, some of them are getting onboarded as we speak. And for next year, we already, like I said, we have already had offers of about 46,000 for the campus. And so it's a pipeline which is building for next year as well.
So attrition is not a worry, because that was the biggest concern a year ago. Now it is about maximization and utilization.
Absolutely. Attrition, yes, I think the point is we were at 20.1 compared to 21.3. It's 4.2% quarterly annualized reduction. Although 1.2 on LTM side, but 4.2%.
Is that because the job market has changed?
That is partly, and partly because of us, partly because of what we do with our people, and how do we make sure that they remain engaged. Engagement with purpose is important for us, for our people. Now, how do we keep them engaged at work? Even something which is adjacent to work as well. And that is what has been TCS for many, many years and decades. That does not change, we only improve from there.
Samir, we're talking about decades here, and every decade has seen two cycles at least. One sugar rush followed by a drop. If this is the year of volatility, I'm using the word slowdown, you're using the word volatility. How is the 2023 volatility cycle different from the previous cycles?
So let's look at the previous cycles. We could start with GFC. We could start earlier also. In
GFC.
each of the,
I'll
start with GFC. But as you said, we are there for 50 decades, so we have history on it. But on GFC also, what you saw is there was an immediate fall off the cliff, and at that time, the concerns were also very. Companies vanished. It's not. You don't expect it coming this time here. There also, there was an immediate increase in revenue. For TCS, for the next 4 to 5 years, we were in strong double-digit growth. And what drives that is, as I mentioned in our previous conversation also, that technology will then become, and more technology is getting embedded and becoming the driver for change, whether it is in terms of transformation or in terms of getting an organization or an enterprise which is more resilient, agile. So that is something which we believe should play out.
So the GFC crisis lasted for almost 2 years, 2 to 2.5 years. Then came the Brexit issue, which also lasted for 2 years. Now, if this is a global slowdown or a realignment of cost or US regional bank or UK or everything put together, will it last for at least 15 to 18 months? Because that's history.
So timing can be plus or minus, but should be in that range. And if you look at it from a TCS perspective, even in the peak of GFC, it was 1 quarter of negative and then positive growth coming in. During Brexit, we used to call out that UK at that time also was growing strong for us. Even during the peak of pandemic, we had 1 quarter of negative and then followed by strong growth coming in. So I wouldn't quantify it as a period because that's the uncertainty. I'd not want to get into a crystal ball gazing thing. But in the range is what we should expect. The medium to long term should definitely be positive.
What to your mind has dramatically changed between 1st of January 2023 and 1st of January 2020, 1st of April? Because there seems to be a change in tone and tonality and the line of communication. I'm not blaming it on I'm not holding it against the commentary, but this is the reality we live in. This is the dynamism of the world. So from a client standpoint, what has changed dramatically?
Absolutely. You called it out right. So what we saw at the beginning of the year, I called out on the UK and Europe side. And what we are saying also, we are seeing incremental positive coming in.
So UK was bad, it is becoming better.
What has played out is on US side of it. What we expected at the beginning of the year, when going into February and March, given the financial volatility which happened and the banking crisis happened, has led to clients being risk averse, cautious, more cautious than usual. And that is what has played out. And the immediate reaction was to put a stop on a significant amount of discretionary projects which were there, projects which can be delayed. They want further certainty before they start projects which are not critical.
Fair point. So, we've had an extraordinary high attrition rate for the sector per se. Historical hikes or the hikes at least in the last 2 years were above the historical average. Do you see a big change happening there? Will things revert back to the mean? And if that happens, then we are looking at a huge change in terms of the operating cost, margins and other factors.
I will not speculate about others, but I will speak about TCS. Our hikes.
But a good manager always tracks competition, no?
Let me just tell you. Let me start with me, and then I'll touch upon that also. Our hikes this year will be similar to what we have been giving.
Okay.
Especially for high performers, we are definitely are looking to get them to 12 to 15% hikes, and then for 8, 5, 1.5 is kind of that kind of number which is coming in. So that is good. That has always been like this. Actually, better than what we have done in the previous years. So that does not change in spite of all the things which you talk about, margin and cost, that we do it irrespective, and then we again traverse the year right together. I think, and obviously variable pay, quarterly variable pay, all of that is 100% in the last quarter. So we have to keep those things intact, irrespective of what we do, how we manage other things. And that is how TCS has been all along, and it continues to be like that. With respect to overall industry, yes, we have seen many things. We are seeing other companies, smaller companies, letting people go. I'm saying opportunities is open for everybody to, take an opportunity in TCS, and people are welcome to apply, and we will obviously glad to have them.
Samir, now TCS even in last 2 or 3 quarters has really struggled to go to the upper end of the margin band, the aspirational margin band when things were looking up. In a volatile environment, what happens to that aspirational margin band? I mean, now it will look like not an aspirational band, but it may look like a dream number.
Okay, so let's look at FY23. We put out a plan in terms of how we'll get back to a thing, and for most of the quarters, we stuck to the plan. Given that there was an immediate fall on revenues, whereas in the short term our cost remains sticky, is where we couldn't exit at 25. I think we have significantly invested into building our cost structures, which would be better, which was starting with 3-4 quarters back in terms of flattening of pyramid, then looking at not increasingly backfilling attrition with lateral hiring, looking at subcontractor structures, and all of it is a continued exercise where we are looking at cost structures, which will help us. And as I've always said, our long-term cost structures are well placed for us, which we as a management team believe that we can operate in 26 to 28. The volatility impacts in the short term, but we definitely believe once things stabilize, we can revert back to our long-term cost structures, which would be then operating in a comfortable band of 26.
So Samir, while we can judge the numbers by saying that okay, it was the slowest quarterly growth in last 10 quarters, margins were under pressure despite the currency tailwind. One thing is clear, if I summarize by saying the next 2 or 3 quarters would be hard to call given the macro dynamism. Will that be a fair assessment?
Yes, given the uncertainty, we would believe that we'll have to play it one step at a time rather than taking a forward view on it.
And it will be tough to get double-digit growth in FY24.
No, I would still aspire to get to double digit. Depends on how it plays out.
Okay, well, wonderful. Good luck.
Thank you.
Thank you for joining us. And for the moment, it's back to the studio.
Back with the market right here on ET Now. You just heard from Samir Seksaria, the CFO at TCS, and Milind Lakkad, the CHRO, about how the quarter went by, and we're waiting to hear from the entire rest of the top brass as well, and especially Rajesh and Kritivasan as to where they see TCS's business headed. But let's ask Anand Tandon as to what he's made of TCS's numbers. Anand, hi, morning. Disappointing at that, and the ADR already is, indicating the disappointment that the market as well is feeling. It's down about 2% overnight. Wondering whether you're bracing for a knee-jerk reaction on TCS today?
There should not be a knee-jerk reaction. It is as, it's not like people were expecting to get a very good result coming out this quarter. The more fundamental issue is that, we've got to a stage where the margins now seem to be, even though the numbers are coming back to, in terms of growth, etc., to pre-COVID levels, we still have a problem with the margin. And the margin clearly has been a miss, even though they revised it not too far back. So that's been a challenge. Going forward, one of the things I just heard the management say in another channel is that, they are not looking to do anything new in terms of the change in management. That to me is a bit of a concern, given the fact that, the technological change that is happening and the kind of coding requirements, the coding ease that is coming through because of GitHub and the assistant that Microsoft has released on it. I think there is a longer-term challenge to the business. Near-term, of course, the deal wins, the deal gains have been fairly robust. So this year is going to be definitely a challenging year for the IT sector. I think the market has already realized that and has traded it down. What we are looking now is just a bounce from the bottom.
That's the take coming in on TCS. Not expecting a knee-jerk reaction because this was, as per Anand, pretty much expected, but it looks like it's even weaker than what Street expected. And the commentary is something which is sounding a lot more cautious because, in the words of Samir Seksara, there's a lot of risk aversion and caution in sentiment in the very near term. Yes, the outlook for medium term is quite robust, but they're not calling whether the next couple of quarters are going to be slower than expected or there is going to be a recovery timeline. So all that continues to be a bit of black box for the markets as well. But other than that, Anand, we're also watching out for what's happening in the oil and gas space as well as the banking space. Let me first come to the banks because the Q4 updates from the rest of them were quite strong, and now we are talking about even the smaller banks picking up when it comes to their liability franchise as well. Do you have any favorite bets from the mid-tier banking names?
Well, I think, given the fact that the dominant factor will be the liability side of the balance sheet, you should be looking at, again, the private sector banks largely. And I'm not a great fan of the smaller banks, though they may be cheaper. The reality is that, they will be putting up assets which are weaker in terms of quality compared to the larger banks. So at this stage, I would stick with the private sector banks, and among the public sector banks, maybe a Bank of Baroda and SBI at best.
Right. Okay, that's the take coming in on banks. But how can we not talk about pharma, considering that was the big buzzer in trade yesterday? Beat that big breakout on Divi's, Laurus Labs, healthcare names like Metropolis as well held out very smartly. And then, of course, there was DRL and Cipla as well, which continued their uptick. Anand, some renewed vigor now coming in for pharma. Wondering whether you're at all invested in the space or recommending so?
I think so. I think this is a sector which has underperformed quite considerably for a fairly long period of time. So now the time is it coming in. The API market in the US seems to have stabilized and has started to do quite well. So I think most of the API players in India will do quite well as well. And the numbers that you are likely to get from, for example, DRL, etc., this quarter will be quite good. So overall, I think certainly it is time to go back into pharma and perhaps specialty chemicals to some extent.
In the meantime, let's just get in a view then on the charts of some of yesterday's interesting movers, particularly then on the Nifty 500, while you did have the broader markets that moved pretty much neck to neck with the frontliners as we surpassed that 17,800 mark. Some of those fertilizer stocks were abuzz. Kunal, your take on the likes of National Fertilizers, RCF, FACT, etc.?
So from the non-FNO stocks, FACT looks attractive after a very strong rally, I think in 2022 second half. The stock went into a major correction. The correction was very classic in nature because it retraced back towards the exact 61.8% mark, which is a Fibonacci level for the stock price retracement. And from there, the stock has started to get into a reversal or a rally phase. And I think over the last 2 or 3 weeks, the rally has been more consistent. Of course, yesterday, the price action was very strong. So that reinstates the fact that that 61.8% support or the support which the stock had hit just around that 230-40 mark, that's a very strong support now for FACT. From the FNO stocks, Chambal Fertilizers and Coromandel, specifically Coromandel looks very attractive, trading at 930 odd mark. It's on the verge of a breakout of swing patterns as well as major resistances. So that's a stock which looks attractive. And even Chambal Fertilizers is going to a recovery phase. Looking at the correction over the last 6 to 8 months, I think it's a good stance to go for a long into these kind of trades because the risk reward is very attractive.
Okay, meantime, some of the other interesting movers, Divi's Laboratories, of course, shone bright in trade yesterday. Nooresh, a quick take on that, and no real trigger, but SIS soared a solid 8%. What do the charts look like?
So Divi's Labs, more interesting part in the move is the fact that the volumes were very high. So over the last 1 year, say we've had this volume and price spikes more on the downside. So yesterday was a 10x volume day. From that zone of 4,600, the stock drifted every quarter for the last 3 quarters. On the quarterly results and post that, we saw 5 to 10% correction with a 5 to 10x volume jump. So that was the trend. Yesterday's move, which was a good almost a 10% move, it happened with very large volumes. So that's generally an indication of a bottom being in place. And that is how Divi's has behaved over the years. So I would expect that the bottom is done now and the stock makes a slow and steady recovery towards 3,600 to 4,000 levels. Dips to 3,100, a drift off over the next few days would be a buying opportunity. SIS is something which has gone through a sideways to a downward trend, so not really looking at it. Looks like just a one-off day.
So also talk about the earnings which are expected. Then of course over the weekend we'll get the numbers from the banking major as well. HDFC Bank will come out with its earnings come 15th of April. We already have the Q4 update with respect to how the deposit and advances have panned out. But Anand, with respect to the stock trajectory, are you expecting HDFC Bank to continue the kind of performance that it has in the recent past?
Well, the very recent past, HDFC has done well, but after a long gap. So, I would expect to see that it's actually trading at marginally lower than its historical kind of numbers, price to book and so on. Of course, there is some amount of issue because of the merger that is impending and therefore, the ROE fall. But even then, I think, given the kind of growth that you are likely to witness in the credit side and their ability to continue to have low cost CASA, it will really mean that their earnings at least should be fairly robust. So I would imagine that as I said, the private sector banks in particular, the ones that have not done well, including HDFC and perhaps Kotak to some extent, are likely to be the ones that will perform well.
Okay, but let's get back to the conversation with the TCS top brass. Nikunj is in conversation with Rajesh Gopinathan, Kriti Vasan as well as NGS.
Right, Nisha, thanks a lot for that. So let's take our conversation forward. We've got NGS, Rajesh and Kriti. Gentlemen, it's the first time I have all three of you together. Absolutely. So is this an indication that the top team has to come together and really give a lot of clarity about the environment?
This is an indication that the top team thinks very similarly.
So Rajesh, what are we starting with? TCS or your second life?
TCS. Second life we'll do separately.
Rajesh, from a market standpoint, the communication needs to be perhaps on the lines of immediate, which is short term, medium term and long term. Long term, IT services will be relevant. Medium term, the cloud adaptation is real. But the short term is where there is a change of heart, business, volatility and visibility. How would you defend that?
I would say that exactly what you framed it. From a market perspective, that's an important call to take. But from a company perspective, actually that is not a very important decision per se. Because if you look at our overall stance on our operating stance, that does not change significantly given the short-term volatility that we are seeing. We are continuing to stay very engaged with customers. The deal flow indicates that both our relevance as well as our ability to close and engage with customers is very strong. Operationally, there is quite a lot of activity that is going on to actually recoup some of the operational stances that we had pre-pandemic. And that activity does not matter whether, in fact, if there is some weakness, it actually accelerates the space available for that reset, especially on the contingent labor side, where we rebalance it back to our own employee base on the on-site side. So, from an operating company perspective, the 1 quarter, 2 quarter is not a very big thing. From a market pricing perspective, it has implications. There, we are not able to share much. I have shared as what we said, that we expected something different. We expected it to bounce back. That expectation was based on the overall strength of the individual clients that we were with, the overall economic strength that we thought was there, and something not just our assessment, our clients' own assessment of where their business was. If you look at it, it has not significantly changed. There is caution, and that caution we had expected it to dissipate. Instead of that, the caution has intensified, and therefore it is natural that they are becoming a bit more risk averse and wanting to see how this develops, and we are participating in that and getting impacted by that. So, as I said, from an operating company perspective, this is not very material, but from a market perspective, especially those parts of the market that needs to price it for a more shorter term, that needs to, but there's nothing further that we can share.
Kriti, now it's not for the first time we've gone through a volatility or period of uncertainty. TCS has got a 5-decade history, and many times we've seen even bigger concerns. But if I look at the slowdown patterns, GFC crisis, right, Brexit issue, they've lasted for at least 4 to 6 quarters. Right. Will this time it be different?
Our hope is this will be different.
Why?
As I said, during the GFC time, digital technology, digital transformation was just coming of age. and the importance and relevance or centrality of technology was not as high as it is today. Today, every industry thinks technology is a game changer for them. New products and services are being introduced based on the technology available. So they have to fall back on technology to achieve growth again. So those things give us a confidence that this time, once the uncertainty is over, people will look at deploying new technology for furthering their growth. This actually will be an enabler for future growth. This will actually enable them to get out of the situation they are in. That's our going in position.
And just the crisis is with a handful of regional banks. Do you have a direct business with them? And if the crisis is only limited this time to small regional banks, then what is the uncertainty about?
Our exposure to regional banks is very marginal and it's not significant. The confidence that we have is also coming from the fact that there is it is not a chain reaction that's happening, right? Unlike the GFC crisis. When something went wrong, there are several banks got impacted. Whereas in the current situation, it seemed to have been isolated to two, one in the US and one in the Europe. And they have been largely contained with a tremendous amount of government support on either side, right? Our government interventions, which were very timely, right? Thirdly, I think, the order book that we have got this quarter, 3.1 billion from financial services, doesn't seem to, correlate to that, right? In the sense that most of them feel that these are projects that need to be executed, right? And it's also one lumpy deal we've got. At the same time, several small to medium-sized deals, which augurs well for our execution on a quick and timely basis. Thirdly, I think we have built the capacity, we have trained the people, and as Rajesh pointed out, the time is ripe for doing some of those operating model interventions in terms of getting down the contingent labor down, right, and improving our own utilization, all of that thing, right. I think these two is what we'll have to do in the short term, right, and continue to look at the pipeline that we have, which is again quite good, quite robust, and convert those pipeline into deals as quickly as we can.
So, Anjay, I distinctly remember last time when we met, my question was phrased on the following, thought. Was there a probability or a possibility of a double-digit growth? And you emphasized on the word possibility. So, looking at the start of this year, the word possibility of a double-digit growth is completely out.
I think it is a possibility still.
Still a possibility.
I would say it's a possibility, because our exit rate is good, our deal pipeline is good, our order book looks good. Customers feel that let's spend wisely, there is some deferment, no large-scale cancellations. When I put all these things together, I think it should augur well for our growth. But then, we have to wait and see what happens in the next 6 to 8 weeks, right? And it's also an election year, in many parts of the world, right? So we'll have to see how these two things play out in the next 1 or 2 months. But if I look at what we have as order book, what we have as pipeline, what we have as capacity, and the challenges on the supply side abated, if I juggle all of these things, the possibility is there.
So, Rajesh, if I connect the dots here, your opening remark with his confidence that this is going to be a short-lived volatile patch, NGS's comment that there is a possibility of a double-digit growth. Can I say that while it will be difficult for you to pinpoint the accuracy in terms of whether recovery will happen, you are reasonably confident that this is just a small passing phase? This is not like any kind of a structural decline, or you need to revisit your earlier assessments?
Absolutely. Absolutely, we believe so. And it's not just hope. So if you look at it, we are very confident about the ongoing strength in UK. And both our momentum as well as the deal flow that we have seen. UK is on a good wicket. Europe, we hope that it has bottomed out and should start turning. And Europe has been sequentially slowing, so it's been a drag. And even if it flatlines, it will actually start improving the impact from a company perspective. And there is an opportunity for that to start improving. US, as I said, we don't see structural challenges there. We are like, even if a technical recession actually happens, there is enough resilience in that economy. The clients that we see, we don't see many weak clients, and therefore that should also give us. So there the timing issue is there. So it's more of a timing rather than a structural problem, and we are executing on that belief and doing everything that it takes to position us for that.
So could the next quarter when we meet, would TCS be in a position to give us a better clarity? 6 to 8 weeks, what NGS just said.
Yeah, we will give you all the information we have, and we will give you our impression. I don't know whether that would be, you can call it better clarity. Like we are hoping that there will be less volatility, and maybe there will be greater understanding of what's going to happen.
I've read through 5 brokerage notes in the morning, and folks who've been tracking you for years now, all of them are raising a red flag or underlining the word slowdown. Do you think everybody is overemphasizing on the quarter gone by and the current quarter? That's not the right way of looking at things.
See, the way we look at it, that's all I can talk about. The way we look at it is like last quarter there was a certain amount of uncertainty. There was some projects were deferred. And if you look at the long term, we believe there is enough demand for technology over a medium to long term. There would be the uncertainty will weather off for a period of time, and like the way it happened during the COVID, like the first couple of months, everyone was in shock. After that, they realized is that once this initial concern dies down, people will get back to the old ways where, as I mentioned, that technology is going to give them the competitive advantage. They will come back to spending on technology or investing on technology.
You know, Rajesh has been kind enough to extend a coffee invitation to lunch invitation. That's why we'll have chat about what he's planning to do. But I will not do my, karma and dharma as a journalist if I don't ask the CEO designate. That is there a restructuring happening in TCS? That's what we understand at various vertical levels.
Actually, like I've been answering this question so many times. Okay, like restructuring is not our priority.
Then there's nothing happening. You want to deny it, you can deny it.
Our priority is going to be talking to the customers, talking to our associates, finding out what needs to be done. If we need to do some tweaks, we will do a tweak. So it's not, restructuring is not top of mind.
Okay. Rajesh, so the invitation from coffee has got extended to lunch now is what I understand.
Lunch, dinner, बहुत ही time
NGS, I go back, I may sound slightly repetitive this one, but what the idea of today's chat is to perhaps get this communication right, that how is 2023 slowdown different from the previous cycles? I'm being repetitive with this one, but that part I think needs some addressment, because what markets are doing is that they're doing parallel between the Brexit time and GFC crisis and blowing things out of proportion. At least that's my understanding.
I think they are different as we see it, and I think I explained it, because we don't see a chain reaction.
You don't see a chain reaction?
I don't see a chain reaction, and I think we have learned to enjoy uncertainty. Yeah. I think we have got enough offerings, enough work to do in the near term, which will augur well for our medium to long term growth.
Rajesh, 2021, you came out and you said that you are mega excited about a multi-year cloud architecture which is at play, and this is a multi-year cycle, and next 2-3 quarters the numbers were absolutely out of the park. Any reason to believe that whole thesis could get challenged?
No. If you look at how it has played out, last 2 years, we have been in the mid-teens growth, 15%, close to 14% this year. And that's a lot of it has come out of cloud being one of the major drivers of that growth. When we look at our customers, the cloud agenda continues. We had called out a few quarters back that this year is likely to be a year of execution focus on the cloud side. There was a lot of excitement. There was a lot of energy that had gone in. The business cases we still believe is true. The roadmap is very secure, but the extent of investment and focus on execution that was required was not there in the beginning, whereas that will be where the play will be. And that actually is good news for us. So while you're seeing the froth coming off on incremental cloud sales from a hyperscaler perspective, but for service providers like us, it's actually now comes the heavy lift. and therefore the demand side from a cloud continues very strongly for us.
So last question, and I'm going to quote one of your media interactions. You said 2023 will be about repair. It will be about implementation. It will be about getting the margin back in order. But that comment was made when the US problem was not there. That problem was made when the macro in the regional US banks was not there. So what changes in that statement of intent, which you made in December?
I would still say that the execution focus remains the same. It is about consolidation, it is about repair. I spoke about the operating model, that we are too leveraged on contingent labor. That a cost implication, it also has a delivery and a customer experience implication. So those repairs need to be done. There is a lot of work that needs to happen, and an operating model, many things that we are experimenting with needs to be scaled up. So that continues. The uncertainty on the revenue will flow through, and we need to make sure that that headwind is dealt with appropriately. But we don't need to jump into it immediately. We can afford to wait and let it develop a bit before we take any active stance on it.
Well, Kriti, once again, congratulations on your appointment. Must say that you'll have to get used to, dealing with press every quarter now. Not that it's something new to you, but that's a different world.
Sure, Nikan, thank you.
NGS, always a pleasure. I look forward to interacting with you next quarter. And Rajesh, it's the last time we're speaking to you in this formal capacity, but you've been a great supporter of FITI now, a personal friend, one of the young leaders who's inspired me always when I want to look at things and team management. And, TCS shareholders, they should be mighty excited under your tenure. It had a commanding premium, best margins. So thank you for all that. And I'm going to be personally missing you a lot from next quarter.
Very kind of you, Nikunj, and same here. We'll miss this intensity of interaction, but
lunch or coffee do you have?
Convert it into something else.
So let's back to the studio.
Thank you.
Yes, Rajesh Gopinathan will be missed at the top, and what will also be missed is the clarity with respect to the outlook going forward. But at least there is some sort of commentary coming in, especially from Rajesh, who talked about that Europe has bottomed out. They're expecting an improvement from here on. UK is something which they're very confident about, the strength that they're seeing in the pipeline of the deal wins. And US also, he believes it's not a structural challenge. It's only a timing issue with respect to the ramp up slowing down, as well as deal conversions being slower, but not a structural issue. Maybe just a quarter or two is something that we need to watch out for. Even NGS reiterated that 6 to 8 weeks is a very important time for us to watch in terms of how this is likely to shift, because for now he's not seeing a contagion effect or a chain reaction happening, which was the case in GFC as well as 2008 and the Brexit time. And that's why perhaps Kriti, the CEO designate, is quite confident that the bounce back this time will be faster than what we have seen in the earlier down cycles, and the demand remains quite robust in the medium term as well. And I think the street is also buying all of that, because there's not a huge negative reaction on the stock in the pre-open. Let's pull up the pre-open rates. Nifty has stabilized just around that 17,800 mark, but let's see what the IT counters are up to. As far as Infosys is concerned, it was showing a downtick of around 1% when I had seen it earlier, but TCS was holding on marginally. Okay, so that's also down about 1%. It's not a huge cut coming in. Of course, as far as the EPS is concerned, the analyst recommendations have also changed by just around 2 to 3% at the EPS level for FY24. So not major cuts coming in, but all the IT packs seems to be on the back foot, whether it's Wipro, Tech Mahindra, and all eyes will now be on Infosys if the commentary is any different from what we have heard from TCS, because Infosys, they flagged out the impact on insurance, high tech, retail, etc. earlier as well. So the commentary from here on will be important, and at least they give out a guidance for FY24, so that number will really be crucial to watch out for. So that's about the entire IT pack. But what about the index today, and how should one approach the markets at this point of time? Kunal, what's your call at the index level at 17,800? Is it still a buy? Is it a hold at these levels?
Yeah, it's a hold at current levels, but then, I think if there is any kind of an intraday dip, that should be taken as a good buying opportunity. So what we are actually going into right now, Nisha, is more of a risk-on trade across the globe, where you've seen so many of the asset classes, whether it's gold, silver, Bitcoin, global equities, whether it's developed markets or the emerging markets. Most of these indices are coming back to their 52-week highs or life highs, or maybe multi-month highs for themselves, and that generally happens when there is a strong risk-on phase in the markets. And in phases of risk-on, the markets generally resistances like 17,800, they act as more pit stops rather than hurdles for the indices. So I think maybe a couple of days of sideways range for the indices, but netted we should be looking out for a breakout beyond that. So if there is any kind of a dip, say 100 point, 150 odd point dip on the Nifty, that should be taken as a buying opportunity.
Okay, any dip should be bought into immediately. Let's also talk about what's happening within the mid-cap end of the market. Kunal, your mid-cap ideas?
So that'll be a buy on Anantraj Industries. My earlier targets were closer to 140. So the stock has crossed above those levels. I believe now at 141, 42 where the stock closed yesterday. It seems to be that the stock is opening a fresh leg on the upside. More of a monthly chart breakout now for 155 as a target. Would suggest a buy with stop loss to be kept at 135.
Right. Nooresh, what about your mid-cap strategies?
So I would repeat a buy on Laurus Labs, which I covered last week. A buy on Laurus Labs. Finally, the stock has made that move above that 320 mark. It was making a base around 295, 300. Corrected from 700 plus levels. Yesterday was a good volume day. Expect some more follow up here. An intraday dip today would be a buying opportunity. A stop loss at 306 and a target price of 350, 360 in the short term.
Okay, let's move on straight then to some of the other top headlines that we're tracking in our News Fatafat segment. And investing legend Warren Buffett is seeing the possibility of more bank failures down the road, but depositors need not be worried. He said that some bankers will continue this behavior, but the system is set up to protect the entire nation's deposits. Meantime, you've got Chinese e-commerce giant Alibaba that has actually tumbled after SoftBank reportedly sold its entire stake. Reports suggest that SoftBank sold roughly $7.2 billion worth of shares in the Chinese e-commerce giant via prepaid forward contracts. This will leave SoftBank with only 3.8% stake in Alibaba.
And Warner Brothers recently announced that it is combining content from HBO Max and Discovery Plus to roll out a new streaming service called Max starting May this year. Now, the company seeks to take the fight to streaming leaders Netflix as well as Disney. Also, Ukrainian President Zelensky met US senators of the Democratic as well as Republican parties and updated them about the conflict, including the situation on the front line. The participants of this meeting also discussed the future ways of American aid and the role of Congress in this particular process.
Delhi High Court has issued warning to hotels and restaurants asking them to not portray its stay on government service charge order as if the court has approved charging the same. The court has asked hotels and restaurants to consider changing the name of service charge to Staff Welfare Fund as the term is misleading to avoid confusion that the charge is levied by the government. Historic moment coming in for India as Kolkata Metro touched a milestone by running through the tunnel under the Hooghly River. The Metro rake undertook its maiden journey from Howrah Maidan to Esplanade as well. This is the first time for Rajasthan Royals to win at Chepauk since 2008. It's a big achievement to win in the dew and against a raucous home crowd. CSK showed again the ability to remain unfazed, yet Rajasthan Royal came out virtuous in the match that happened overnight.
All right, let's find out what those index calls are. What is it that our chartists are advocating one should do with trading on the index? Remember this after we managed to surpass the coveted 17,800 mark in yesterday's trade. It seems like it's tilting towards a hold, though Nooresh is saying no trade right now on the index. So that's the Nifty consensus call or the market moodometer, hold on the Nifty position. What about the Nifty Bank Index then? And with support coming in from the large caps, what's the advice? It seems to be a hold recommendation yet again. No trade, says Nooresh. And the majority seems to suggest that that's the strategy to adopt on the Nifty Bank Index this morning.